Okay, we'll go ahead and get started. So thank you guys very much for joining. I'll let Doug introduce himself in a second, but first we of course need to say that anything you hear today is general advice. So we do want questions, send questions in the chat, send questions over the Q&A feature, but everything is general advice. Doug and I don't know anything about you, so we obviously can't answer any personal questions. But we will get started. So we're going to talk about resilience today. And I'll provide a little bit of a lead in. Doug will go through some features with Sharesight. But first, Doug, would you like to introduce yourself?
Sure, I'm happy to. Hello, everyone. My name is Doug Morris, and I'm the CEO of Sharesight. Been there for, over 10 years, which is pretty hard to believe. And before that, I actually worked at Morningstar for about 10 years. So the entirety of my career is spent with these guys, our friends here at Morningstar, and with Sharesight. So from the States originally, as you can hear in both of our accents, but been living in Sydney for over 15 years now.
Great, thanks. And for people who don't know me, I'm Mark LaMonica. I've also been in Sydney for 10 years. I look after our content at Morningstar. So articles you find on our site, podcasts, videos, things like that, and webinars. So let's get into the topic. So, we thought that, and this is the first of quarterly webinars that we will be doing together, Sharesight and Morningstar. And we thought a good topic would be resilience. There's obviously a lot of anxiety out there around what's been happening in markets, tariffs, as you're all aware. And we thought it would be a good time to talk about resilience, I think, in your life and also your portfolio. The one thing I did want to say before we get into this is, I think that a resilient portfolio, and you hear the industry pitch these a lot as all-weather portfolios, the idea that they will perform well in any environment. The only caveat I put out there before we begin this is, of course, constantly rotating your portfolio into something that you think seems appropriate for the environment probably is not a great approach. You are likely too late by the time you do that. But I do think it's important to understand your portfolio, which is why we are going to look at some of these Sharesight tools and understand some of the different risks, some of the different things that are going on with your portfolio. So that's a little add-in I wanted to do at the beginning. I'm going to turn it over to Doug. Doug is going to show some Sharesight tools, and then at the end, I will talk a little bit about, and I'll show our research and how you can think about shares and the different trade-offs that you have based on our research ratings. So I will turn this over to Doug. We're just going to slide this across.
Sure. Alrighty, any fat finger mistakes just because I'm not used to Mark's computer, but that's my excuse up front. So I guess it's quite interesting because almost for my entire tenure at Sharesight, the market was like on a bull run. I mean, the company actually was founded during the GFC, actually, in 2008. But since then, when we gained traction and grew the business, it's all kind of been up and to the right, so to speak. And in fact, doing these presentations and talking about our software and kind of what we do got a little bit boring after a while because every portfolio looked fake because it was just like up and to the right. And then it was all about, the FANGs, then it was the Mag 7, and then tech, and then AI. And it just was kind of just this runaway train. But what's happened, I suppose when interest rates rose end of 2021, and then the volatility we've seen since there, personally, we think that Sharesight's worth more to the average investor than it is when things are kind of going kind of well, So we do have a range of tools to help investors keep track of their investments and also to analyze risk and how they're positioned as well. So what I wanted to do is just quickly remind people of a few things that we can do feature-wise. I'm just going to move.
Yeah, you can get that out. Yes. I left a window open on my computer.
And so the first thing here is that I'm looking at a performance chart of my portfolio, and I wanted to just highlight our benchmarking. A lot of our customers, and we see this in the data, are benchmarking their portfolios against the old tried and true indices, right? So whether it's the Dow still, or the S&P 500, or in this case, the ASX 200. What we do though is it's a bit different. We don't compare your portfolio to like the price index, because often when you just look at the index, if you're looking at morningstar.com.au or you're looking at the Fin or something, you're going to be looking at a price index, and that's not exactly a reflection. In fact, it's not a reflection of how you're actually performing. And so what we do is we provide an alternative ETF proxy to that index. And then when you set that benchmark, you can track hypothetically how your portfolio has gone against that same ETF over time. So it basically is a like-for-like comparison. And so a lot of our investor clients are benchmarking things against those indices. You can see in this case, I've got the ASX 200 on. But you might be thinking to yourself, well, a more appropriate benchmark these days might be something like one of those all-weather funds or ETFs, like Mark mentioned. And so what I've just done here, I've actually just switched out the ASX 200 ETF to the VDHG, which is something that I personally like to use. It's a diversified high growth blend from Vanguard. Not a product endorsement by any means, but I like it because I think of this as like a plan B for my portfolio. So if I don't know what the heck is going on, like I don't feel like I've got a grasp of things right now. And I think about kind of using this ETF as a fallback position to allocate some of my assets into, if I'm sort of I don't know what's going to happen. I want to be more diversified and go with something that kind of touches all corners of the market. I might think about something like a blended ETF, and they've got a range of these from conservative to high growth. And you can see in this case, over this calendar year, in fact, VDHG has outperformed my portfolio. And this is a real portfolio that I have. Some of the numbers are changed, but this is legitimately, I've been outperformed by a diversified high growth index, which is quite interesting because my portfolio has been quite tech heavy.
Yeah.
So just kind of on our front page right there, the benchmarking feature packs a lot of power.
And I think it's nice that because I always get questions about benchmarking, and if you own a globally diversified portfolio, what are you actually benchmarking against? Obviously, if you have anything that's not equities, you lose any sort of value you get from benchmarking against.
Yeah, I was helping a close friend develop her portfolio recently, and I was kind of just talking in a roundabout way of basically what we're doing is building a diversified ETF that you could buy off the shelf. And that's kind of where you come back to. And so those diversified ETFs that aren't that popular, I don't think, by asset size, are good to look for. And Morningstar also has multi-sector indices, which I use as well, which are really kind of similar, if I'm not mistaken.
Yeah, no, absolutely.
Yeah. So that's just something to highlight on the homepage specifically. Another thing that I wanted to highlight was in our reports menu, and we have now released a couple of new reports that deal with exposure and risk specifically. So our diversity report, which I probably won't go into now, is an asset allocation report. It'll show you your breakdown according to industry defined sectors or industries, or ones that you choose as well. Exposure, I'll come to that in just a moment. But our risk specific report that's actually quite new is drawdown risk. And so what this report does, it examines sort of peak to trough movement for the constituents in your portfolio. So it'll show you over a given time period what the relationship is between maximum drawdown, how long it took the investment to recover from that drawdown, and it'll compare that against your performance as well. So it's kind of like answering the question, how risky was the path that I took to achieve this return on an investment and a portfolio basis. So I'll just run this now. It's a pretty crunchy report, so let me just give it a second to do its thing. So what you can see in this case is a really pretty, if not confusing, bubble chart. And the way to interpret this is that the y-axis is on the left side. The vertical axis is your return, so annualized return, which we calculated at Sharesight. And the axis going left to right, the horizontal axis, is maximum drawdown. So in other words, top right is risky but high returning. Bottom left is less risky but less returning. And so the quadrant that you do not want to be in is bottom right, which is high risk, low return. And this is plotted with relevance to the portfolio itself, if that makes sense. So what's cool about this is that you might be looking at this thinking, geez, well, what the heck is Doug invested in that's up here that's super risky and performed quite well? Well, maybe no surprise to some of you, that's Bitcoin. So that's just a holding that I have in Bitcoin, the currency which you can track on Sharesight. And you can see just with respect to the other investments in the portfolio, how much of an outlier Bitcoin really is. So the maximum drawdown since 2022, which is the default time period in this case, was 64%, right? So that's quite significant. But my return has been 204% annualized per year. So just something to consider. I mean, Bitcoin, we probably won't dive into a Bitcoin discussion today, but that's what it's done.
It'll just be a discussion from you. I don't have anything intelligent to say about Bitcoin.
It's almost like I'm out of ideas. I'm going to put some assets into Bitcoin, frankly. So I can turn off that investment on the chart too, which is quite nice. So let me just click that down here in the legend. And then that rescales the chart. So now I have a view of kind of the more traditional investments in my portfolio, which I quite like. So you can see in this case, this one actually stood out to me, CBA. I mean, it's performed so well. It's been written up in the Fin recently around like what the heck is going on with CBA and why is it running?
It's the same article they've published like 12 times in the past.
That's true.
Like 8 months.
That's true. So max drawdown here 19% and the return 26%. So it's just done so well. And frankly, I didn't know what that bubble was until I ran this chart in preparation for this exercise. So there are truly insights here, even to people who keep an eye on this stuff every day. I should also mention too that the size of the circle corresponds to the asset size of the holding as well. So you kind of get the gist there. Now, we also have the data view underneath this. So this will show you the benchmark that we selected on the previous page, the VDHG, and then all the constituents are down here below. And we also develop a ratio, which is called ROMAD, which is a relationship between the risk and the drawdown. And so essentially, if you ungroup your holdings, you can just sort by ROMAD, and the higher the ROMAD, the better. And this is where, again, but Bitcoin is quite an outlier here, 3.18, but you've taken a heck of a lot of risk to get there. It's just that the return of Bitcoin has been so outstanding. You can see CBA at 1.35. That's a more normalized ROMAD score. So all this is in this risk drawdown report, which is really nice. And the other thing too is that we allow our customers to group their assets, again, by kind of commonly understood sectors and industries. But where this really comes to life is if you develop your own groupings. So I come from a background in asset allocation at Morningstar, and I'm always kind of thinking about how I was trained in terms of asset class exposure. I take more of a thematic, like growth versus defensive, as opposed to like telecom versus utilities. Like, who cares? Unless you're kind of keen on those industries, I suppose. So just for sort of basic analysis here, if you have a look at a splitting that I've done, which is just basically called growth and defensive. Oh, I got to click save. Still learning my own product, which is encouraging. I now have bucketed my assets into growth, defensive, and indexed growth. So indexed growth are basically ETF core holdings that I have in a core satellite kind of way. I own those inside of an SMSF, and I own those also in my US brokerage accounts. And then I have some growth assets, which are primarily tech stocks, and indeed some Chinese names in there too, which I've been invested in for a while and kind of holding on to for dear life. But again, that's showing some asymmetry to US returns, which is quite interesting. And then I have defensive, which I can show you what those things are. But what's really interesting here is that depending on the time period you choose, and I might just widen this out to maximum. I believe this will show what I was trying to illustrate. Yeah. So what we have here is we have those three categories, and we have our return on the vertical, our drawdown on the right. And what's interesting is that my defensive holdings, which I'll show you what those are in a minute, drawdown's been almost 38%, which is still pretty significant from a price drawdown standpoint. Return 6.25% per annum. If I look over here, well, these are my growth assets, and my drawdown's been 85%, return 16.88. Because those two bubbles are relatively the same, altitude, if you will.
Yeah.
I'm taking out a hell of a lot less risk and getting a similar return in my defensive assets. So that's like, whoa, like what does that tell me as an investor, right? And how should I be thinking about allocating things moving forward? And then down here is just my index growth, which is pretty conservative ETF kind of investments that I've made. And we're also plotting the portfolio average of the benchmark on all these charts as well.
Yeah, I mean, it seems like people just need to list your defensive assets.
Well, we'll scroll down. We'll have a look at these. So defensive CBA and the VDCO. So again, it's about how your taxonomy. Like it's really important to understand how you're grouping things and kind of the position you're taking when you make investment decisions. Like an investor might be chasing yield, or they might be looking for just a really safe name, and they might go for CBA. I classify it as a defensive stock because it's kind of like, well, I'm thinking like on a global basis, like it's a pretty safe bet, I would say these days, given what's going on in the world. So that's why I have that grouped in there. The index growth are just some of these larger ETFs, both here and in NZ, and then the growth assets, as you can see, are tech stocks, Bitcoin, some of those Chinese names in there as well. So that's just a kind of a one way to use our drawdown report, which is quite useful for investors. And just to kind of show you how you arrive at those groupings in the account menu, in the custom groups menu, we have a drag and drop kind of visualization here. So anything ungrouped over here, you could just drag in to the right. And so I might take a company like American Tower, which actually is more of a REIT. They buy real estate and they build cell phone towers on them. I'll just for illustration purposes, just pop that into US tech, and that's now been reclassified. And you can actually come up with different groupings here. So in this case, I've got core satellite, growth defensive, and kind of a custom one that I just call Doug's grouping, which is more of a thematic view. But it's really nice because that then carries through the product to the performance reports and the asset allocation reports and everything else. One more that I might just show, just because we're on the reports. I mentioned before that the diversity report is just our asset allocation report. That's pretty straightforward. But I will show the exposure report. This is essentially a what's in my ETF report because ETFs now, I mean, they just dominate the inflows from investors, as you guys report on. When I first joined Sharesight years ago, I think it was like 2 or 3% of our Aussie customers had ETFs in their portfolios. Now it's like 30%. And you can see assets, perhaps even more. But if you basically run this report across the top 50 holdings, do not group. Yep, that looks good. Let's get our little widget out of there. What this report is going to show you is basically your holdings on an individual basis and the holdings you have through the ETFs where there might be overlap and distinct holdings. So you can see in this case, Amazon, I own this company directly, which you can see there direct, and I also own it in IVV, the NDQ, the USG, the VDGR, and the VDCO. So, depending on how your assets are allocated, I mean, some of these numbers might be quite significant. If you want to avoid something, for example, I refer to that friend I was helping construct a portfolio. She was quite keen on investing in CBA, but then I showed her that actually she owns 2 Aussie ETFs already. She basically has like 14% to CBA in those large cap Aussie ETFs already. So she decided to stay away from that. So that's where this report really comes to life.
And we see that stuff all the time, just because particularly Australia, but also the US is so top heavy.
Yeah.
And we see people buying ETFs, they'll buy IVV, for example, they'll buy NDQ, being like, oh, technology. Well, you go look at the S&P 500, a lot of technology in there.
Yeah, I mean, I guess I should have, could have, would have, should have, but I've never owned Apple directly. And that's because I've always had so much exposure to Apple through, once upon a time, active US fund managers and then ETFs. It almost creates this like vacuum where Apple sort of just becomes a holding through time because of how it's performed.
Yeah.
And because I've directed assets away from it. So anyway, this report can show you those distinct and those overlapped holdings. Last couple things I'll mention before turning back to Mark. So Sharesight being called Sharesight, it is about listed investments, of course, not just shares, but we of course have ETFs on the platform. We have managed funds, which we get from our friends at Morningstar. But you can also track cash and private equity or custom investments as well, which again is quite important if you really want to have line of sight across how you're performing, especially with respect to those cash and yield-bearing investments. So there's a number of ways to create cash investments in Sharesight. The two most popular are just the manual cash account and the custom investment feature that we have. With the cash accounts, I won't go through that setup process because it's kind of boring to show off how you create a cash account, but it does what it says. You can now link those to your portfolios in Sharesight, so you can almost run those as a proxy to your cash holding account with your broker. So if you make a trade, a buy or a sell, it'll reflect that automatically. If you receive a dividend, it'll also reflect that automatically as well. And now you can actually track those in different currencies as well. So there's a lot of flexibility in those cash accounts there. But if you're thinking about finding some yield, as a lot of our customers would be these days, you can use our custom investment feature to basically come up with a customized investment. So if you wanted to just call this, I don't know, cash 5 and just call this like term deposit ANZ or something like that, you're going to give it a description. And this is where you want to select fixed interest. And then if you tick this very important box here, it will automatically calculate your income based on the schedule you set up. So you can give it a face value per unit, which is just $1. Just keep it $1. That's simple. You can give it a rate. That's your interest rate, essentially. And from there, you can then say, okay, pay me quarterly, beginning on this date, ending on that date. So once you add that investment in, that'll calculate interest payments automatically for you. That'll then get rolled up into your portfolio performance. So that's a really nice feature if you've allocated some of your investments towards term deposits or other, sort of bank account type structures.
Yeah. Especially people, I know there's a lot of people that I talk to that every time there's a little better interest rate, they'll open a term deposit, some different bank, and then they have 9 different banks.
Absolutely.
And you're trying to track that all. And
it's so easy to do so. I actually just did that myself. I mean, this is where like the Aussie banking system is so much better than the US banking system because you can just open a TD on your phone in like 2 minutes, So those accounts do proliferate, which is then an issue at tax time because you got to track it all. So that's why having that here is quite nice. So if I just have a look at, say, one of these cash accounts I've created, there's nothing in there. But anyway, these are just some kind of dummy cash accounts that I've had in there. But if you go into these as investments themselves, here we go. Here's a term deposit. So here's a 3-year TD that I set up. And you can see Sharesight will treat this just like any other investment. And you have performance down here. And then you have your, under the trades and income section, you have your buy and your sell, and then you have your automatically generated interest payments right here. So this is a really good feature for not only tracking cash performance, but also tax time, admin, bookkeeping kind of stuff as well. So I'll stop there, I suppose. But yeah.
I know I did see a couple questions come over.
Sure,
so maybe the Sharesight related ones I'll do right now.
Right, cool.
So I can pass this back to you. Let's see. All right. So Rodney is asking, for people with portfolios with more conservative target allocation, so like 60-40, can you benchmark against equivalent multi-asset ETFs? So I think you've kind of answered that. You have to find the ETF that fits.
You do. So the answer to that question is yes and no, and we're working on it. So yes, you can benchmark performance against anything on our database. So it's like upwards of like 1 million securities. You'll find it. If it's like this might be a stretch, but a Chilean multi-sector ETF, like it'll be in there because we're probably getting that from our mates at Morningstar. When it comes to then, so that's performance benchmarking, performance comparisons, really. But when it comes to actually benchmarking and doing comparatives on asset allocation and exposure through time, that is something we're working on right now. So our diversity report is a point-in-time report. So it's basically like, what is my asset allocation as at date? What we're going to do is extend that on a through-time basis, and then add in a benchmark so that you can then say, okay, well, if I compare myself to, say, a Morningstar multi-sector defensive, how am I tracking in terms of like, am I within or outside of my tolerances there, essentially? So that's coming, but yeah. And as someone who comes from a very academic and boring asset allocation background, I've been keen to see that myself in Sharesight. So yeah.
Well, that's why it's nice being CEO.
That's right.
Because people have to listen to you.
Yeah.
Nobody listens to me here, at home, anywhere.
Big fish, small.
Yeah. So we've got a question from Kumar. and say, how easy is it to put your portfolio into Sharesight? He's relatively new to Sharesight.
It's hopefully pretty easy. We've got a number of ways to do it. Now,
show anything? Or
yeah, I'll show a few things, I suppose.
Let's minimize that for you.
I should mention too that like depending on what plan type you're on, and Morningstar customers have access to our investor plan, which gives you 4 portfolios. I would encourage investors, if you're not using all of those as like proper tax entities, just use one as a sandbox or a playground. You can create a portfolio in any manner of ways, which I can show you here, or you can put in kind of a watch list or hypothetical investments as well. So let me just show you that. So if we went to overview, and let's say we wanted to create a new portfolio. So you give the portfolio a name. So this was Kumar, right?
Yes.
So this would be Kumar's portfolio. Sorry, Kumar. You can give it an identifier if you want to. Tax residency is important. That will dictate the features available to you, namely tax, and it'll also dictate the currency the portfolio is denominated in. And then what type of entity is it, individual, SMSF, or a company. So now you have a blank canvas with which to fill with investments. Our most common procedure is people go to their broker and they interface the broker with Sharesight. So meaning we have API connections with many of the large brokers out there. So it'll send you off to say, let's see if we pick, there's a lot of
people are going to pick Alpaca as the large broker.
Yeah. So say CMC. This will basically direct you to CMC. You'll connect CMC to Sharesight, and all your trading history will come in, and the ongoing trades will come in as well. Some brokers where that API is not in place, it's as simple as downloading your trade history from the broker, which we show you exactly where to go to, and just drag and drop that into Sharesight, and your portfolio will be set up from there. And then we have a listening service, which is basically an email inbox associated with your portfolio. So when you make a trade, you can add a unique Sharesight email address to your broker to send the trade confirms to, and that comes through. So it's just a little bit of setup, but everything will be automated from there. So corporate actions, distributions, dividends will all then fall into place after your trading history is set up. You can also do an opening balance if you don't have the full trading history. So like if like as at 1 July, these are my holdings, my quantities, we can work that way as well. But I would just say like our historical data goes back to 1997. So the longer you go back, the more performance history you'll have, but it does create a lot of stuff in the portfolio, right? If you've got 25 holdings going back 25 years, that's a heck of a big matrix in terms of the dividends, the distributions, the corporate actions. Because if you think about those corporate actions that have happened, and we helped you with those, but like Westfield's had some, Sydney Airports has some, BHP has had some, you name it, that will be reflected in the portfolio. But a number of ways, connecting to the broker, uploading a spreadsheet you already have, or just manually bashing into trades as well, which frankly is pretty easy. And if you've got less than say 10 or 15 holdings, it's really not hard to do so. So, that's back.
One of the attendees, Lisa, today, she owns alpacas.
Oh, really? Like physical alpacas?
Yes.
So you can track those
as
a custom investment for
a custom investment. Yeah.
Price per head of the alpaca.
Exactly. So Rodney again is asking, look through for managed funds.
Not yet available. Potentially on the cards. We would get again that data from our friends at Morningstar. Rodney, one of the things we haven't prioritized that necessarily, almost based on the usage of managed funds these days, and just kind of where those asset flows are going. So it's actually not to kind of get too inside baseball here, but to license that managed funds data, it's so much information. It's like thousands of holdings per fund, per universe, and it's a big development job for us. And so that's where ETFs have been the focus thus far. But we hear you on the funds side as well. Yeah.
And then how about LICs? We have a couple questions about LICs. Okay. Same type of thing as funds.
Same kind of thing. It's just, we know their assets in LICs. It's just not a popular asset class. Certainly not as popular as it was. And so we do not have those underlying holdings of LICs at this stage.
Yeah, but people can still put them into their portfolio.
Yeah. Any listed instrument on the ASX is discoverable and trackable in Sharesight.
Yeah, and I guess just one more LIC question. We're getting into the details here. Is there any sort of comparison that you can do between the NTA and the trading price, or that's really just individually going?
That's just individually look at it. I think you guys might do that on your side.
I mean, we have. You can go in and see what it is if you look up each security.
And there again, not to put this back, the question from Rodney, but like if you want the breakdown on funds, just go to Morningstar and you'll get the top 20 at least, right? For most of the funds in the Aussie universe, I'd imagine.
And as soon as Australia ends its ridiculous non-disclosure of holdings, which I like to complain about, then
that's true.
Then maybe that'll make everything a little bit easier.
That's true.
So a question from David: can existing cash management accounts be linked to Sharesight retrospectively? So he's saying, I have a linked Macquarie CMA, but the interest payments have to be entered in manually.
Yeah, so at the moment, that surprises me. So on our professional edition, David, we maintain a connection with Macquarie CMA accounts, which I suppose you might be on our pro version, given you've done this. Those interest payments should be coming through. We should be taking all manner of transaction, if I'm not mistaken. So maybe just ask our help desk through the bottom right widget what's going on there. Sorry, without looking specifically at the account, I couldn't answer that one on the fly, but those ought to be coming in. Another kind of pro tip on cash for David or customers like David who are kind of more in our professional side or even using Xero and Sharesight, we've got an integration with them. Any bank account that you maintain in Xero, be it a CMA account or a TD, that information can be brought back into Sharesight as an investment holding as well. It's a really good workaround for like the entire universe of Australian cash products out there. So just especially for like family offices who might be on the call or accounting firms, that's a good little hack.
Okay, you actually have a lot of questions. Okay. I opened a different window. The questions come to different places. It's good for me. This is an easy one. Does Sharesight operate on a U.S. time zone or local?
Depends where you are. So it's local if you're in Australia. It'll be our ASX pricing is 15-minute delayed based on ASX opening hours. If you were to stay up all night and look at your Aussie portfolio, that wouldn't change, but your US portfolio would change. Yeah. And our support desk, by the way, is located here in Sydney. I should mention if you're trying to get in touch with us as well.
You actually answered another question from Gary saying, is data live or time delayed?
15-minute delayed, yeah.
So Martin says, do you get information on private equity investments?
Not directly, no. So, I mean, if a managed fund exists that invests in private equity, we will get that from Morningstar. But if it's truly a private equity type, kind of tech private equity fund, we won't. And that's kind of by definition. But again, use that custom investment feature, set it up in there, and then you can update the prices as they release them. If any private equity funds are repricing at this point in time, which it's probably not going to be much price movement there, to be honest. But yeah, you can do it.
And then a question I think you did already answer: do you get 3 or 4 portfolios
for on the investor plan with our relationship with Morningstar?
Yeah, and that was a change. That originally it was 3.
Yep.
And then Sharesight actually made that change.
Yeah.
And added another one.
Yeah.
Which was great. So, question: what subscription provides growth versus defensive as an option in report grouping? So I have an investor account, and I do not have this option for reporting.
So some of the stuff, so what I've actually shown you today, and I should have stipulated that, is the expert plan. So there are some subtle differences in the expert plan, but drawdown risk should be available in the investor plan, as is the exposure report and the asset allocation report.
But that growth versus defensive grouping, you did you created a custom group.
Sorry, I misunderstood. Yes, so that's custom groups. So if you go into the top right to account and you go into custom groups, that's purely your sandbox to play with. So you can come up with any manner of classifications that you want. So that was just me doing what I wanted to do there. So yeah, absolutely. You can come up with your own and then apply that to the reports.
Yeah. Okay. Well, here's one. Is there a plan to track versus multiple benchmarks?
Yes, there is. So we are actually today, there's some workshopping happening with our tech team over in New Zealand. And we're looking at redoing certain reports, including performance reports. So multi-time period and multi-benchmarks are on our roadmap, certainly on our roadmap for the performance report. Yeah.
Okay. I say some of the very specific questions about people's accounts,
Yeah,
like 20 unconfirmed Magellan infrastructure, that's probably contact support
I would say so. Yeah.
for those. Um, okay. If I connect a broker to an existing portfolio, will it corrupt any existing transactions?
Possibly, yes. That's a good question. So if you have a portfolio in place, and now if you've filled that portfolio with trades from other brokers or manually, and the new trades you're introducing from a broker are distinct, that'll be fine. It can go back in time and seed those in. But if it's going to overlap, in other words, if you've built a portfolio, say from a spreadsheet, and then you've gone off to a broker and you're going to overlap that with the same trades, it'll throw up all kinds of warning errors around duplicate holdings and trades. So if you're unsure, always just create a new portfolio and give it a go. But you can add historical investments in at any time to an existing portfolio.
Yeah. So trying to answer a question for you, but you can maybe do it better. Do you have a help area?
Wait,
So I think there's a help
area.
area.
Yep. And then, or just contact our support folks there in the bottom right. Yeah.
Yeah. Peter would like to learn at his own pace the benefits of Sharesight.
There you go.
So yeah, go to that.
There you go.
Go to that help area.
Or just Google it. It's all indexed pretty well. Just Sharesight getting started or whatever. So yeah.
Is it possible to auto confirm the dividend distribution?
It's coming. That is one of our most requested features, and it is coming as we speak. So what that's referring to really is that when you create an investment in Sharesight, we will then automatically populate dividends and corporate actions, and then it kind of shows up as an unconfirmed event. The thinking there was that we wanted our customers to go in and make sure that the information was accurate, which it oftentimes is, but there can be slight nuances where there's rounding issues or a company has a certain rule around a corporate action or a dividend reinvestment price. So it is always wise to check those with you or your accountant. But for the sake of convenience, people just seem to want to just do a bulk like, yep, that's good. And so we're building that. Yeah.
Yeah. Then that takes away the joy of getting a dividend.
That's kind of true,
actually
actually.
click
Yeah.
on it. I like to watch them come into my account.
You can go into, if you go into a holding, you can go into a bulk confirmation for a particular holding. So like, let's say you put CBA in from 10 years ago, you can go in and you can auto confirm all the CBA dividends. Just you can't just do that yet on a portfolio wide basis. So
okay, so I might need to ask for a little, I don't know if this is a Sharesight question, but Belinda asked, could you please explain redemption of hybrids and purchase? I don't know if that's a general question about going out and purchasing a hybrid.
I don't know. I mean, it's hybrids are trackable in the product.
And going away, mostly bank hybrids.
Oh, the bank hybrids that are being shut down effectively.
Yeah. So I don't know if the question's related to that, but anyway, Belinda, if you want to treat them as a sale.
I suppose I don't know. I don't mean to sound sort of lawyerly, but like I would read the tax information provided by the hybrid quite carefully because I'm sure it'll be, is it a taxable sale? Are you merging it into something else? I'm not quite sure, Belinda, what the treatment of those would be necessarily. Yeah, so, but we can handle those. If it's a sell, we can handle that. If it's a merged into another listed investment of some kind, we can also handle that as well. So, yeah.
Okay. So keep the questions coming. I'm sure we might have some in the other window now. Keep the questions coming if you have Sharesight questions, wherever that window went. There it is. Yeah, I think we've gotten one more. I have a corporate investment account and a personal investment account. So different tax zones. How would the reports take into account that different tax treatment?
So if there's different tax treatment, we would encourage you to use, in this case, 2 portfolios. So you have your one for your corporate entity, which is a company account when you set up a portfolio. We have another one which can be individual or SMSF. So you'd run those as 2 portfolios in Sharesight. And then what customers often do is they run what we call our total wealth view. So you can do that at the top right there. If you select the portfolio dropdown, Mark, there should be a consolidated view.
Where am I going?
Just up to choose portfolio. And then you can see down there consolidated views at the bottom. So if you go into one of those, there'll be some mess in there now on this demo account, but overall invested wealth will be just at the bottom there.
Sorry, my mouse does not seem to be working very well.
Sorry.
There we go.
Yeah. So what this does is it combines portfolios. So it'll combine performance for you, but it won't combine tax because tax should be treated separately if they are indeed different tax entities. Yeah.
Okay, great. Anyway, if you have questions for Doug, keep them coming. I'm going to go through a couple things around positioning your portfolio. We can use Kohl's as an example. So I think a couple things to think about from an overall portfolio perspective. I did talk about this in the beginning around, yes, there is obviously a lot of anxiety out there. There is more interest, I think, in a resilient portfolio. Generally, when the industry is talking about one of these all-weather portfolios that performs well in any environment, they are talking about volatility and lowering volatility. So sort of the famous one is from Bridgewater, this hedge fund in Connecticut. And, really what they did is they sort of divided up economic environments into this matrix with inflation going up, inflation going down, growth, contraction, and looked at asset classes that performed well in each one of those. So that would be their all-weather portfolio. They've got some shares, got gold, they've got different types of bonds. So the only thing that I would say that I know that is quote unquote attractive right now, giving some of this anxiety. The only thing I'd say is, we always encourage you at Morningstar to look long-term and think about the trade-offs. So what are you giving up with a portfolio like that? You're likely giving up returns over the long term.
Also, if you're talking about Ray Dalio.
Yeah.
So, how do we as retail investors access the bonds that Bridgewater has access to? And the short answer is we probably can't.
Yeah,
So
exactly.
The fees associated with accessing that kind of pure play institutional exposure is something as well. So jump in there.
But no. And I think that overall it's, number one, we get a lot of advice. I think as retail investors, we get a lot of advice from professionals that, should be pointed out, do have access to a lot more types of investments than we do. And then I think that other side of it is just, remember that trade-off, right? Ultimately with investing, we are trading risk and return, risk defined as volatility. And so, of course, going into a more defensive portfolio, you are going to give up returns going into one of those all-weather portfolios or something that's more resilient as the industry defines it. I think what I would encourage people to do is think about resilience in terms of your own life. If you are a long-term investor and you have, beyond Trump, beyond whatever's going on now with tariffs, think about maybe the most important thing to your life is actually hitting a certain return level. So, I think I would encourage everybody to think beyond what we are going through right now. I think sort of I've seen, and speaking to investors, there's sort of these two different approaches. There's this buy the dip approach that people seem to be taking after very small drops in the market. I think kind of declaring shares are on sale after they've dropped 7% is not actually true.
Yeah. There's that chart that Morningstar provides, the SPPI chart. It's like tracking a dollar invested for 120 years. And the dips are all with respect to what's gone on over time, right? So,
and the dips are big dips. They're 50% dips with the dot-com bust and things like that. So, I think during a time like this, it is important to focus on the long term. I do want to go through a couple different Morningstar ratings. We'll use Kohl's as an example. Kohl's certainly, while we think it's very overpriced, as you can see from this, is certainly a defensive share. But I just wanted to talk about these ratings and talk about these trade-offs that you're making with the different way that our analysts look at things. So I will, that's not what I wanted to click on. So I'll just kind of start with some of our major ratings. We'll get to valuation at the end because I think valuation is important to put things into perspective. But wanted to start with the uncertainty rating because I think it's something that in an environment like this maybe is useful for people. So I think a lot of people there's this probably misnomer that a share is a share is a share. And then when we talk about sort of shares, we talk about bonds, we've got growth assets, defensive assets. But businesses are different. You're ultimately buying a business. And there are some businesses that are inherently riskier than other businesses. And the uncertainty rating is really supposed to capture that. And what it's officially doing is it's looking at our analysts' ability to predict future outcomes and how sure they are. Sure is probably the wrong word. How much how many different factors, how many different factors could influence the path that this company takes? And let's use Kohl's as a simple example. So Kohl's is in a business that's non-cyclical, right? So no matter what happens, you need food. So you're not going to see giant swings based on economic conditions of whether people are going to go to Kohl's or Woolies or anything else. So you're going to see that keep up. So that's one factor that you don't really have to worry about. Kohl's is an established company. They are not some upstart where the range of outcomes in that business are very, very wide. So they are an established company. They do have market share. So that's once again a quote unquote safer company in terms of the swings. And when I say safe, in terms of the potential outcomes that the company could go through. So there's financials. So obviously, if Kohl's, if you have a company that has a ton of debt, then that is a problem if the economy goes south. That's incorporated into uncertainty rating. And the perfect example that I always use is going into COVID, Australia has two publicly traded airlines. They both suffer the exact same fate, that they lose all their business. Well, one goes out of business, so obviously Virgin, and then one stays in business, Qantas. Why? Virgin had a ton of debt. So because of particulars about that company, they were unable to deal with, I will admit, a very unusual and unpredictable situation. But those all go into uncertainty ratings. So, I do think it's another layer that you can put into your analysis of your portfolio. Let's look at these individual securities. And if there's a lot of uncertainty around what's going to happen, obviously with tariffs and the global economy and anything else, you can think about what are the inherent risks within a company. And if you go read the part of our analyst report, in this case, Johannes wrote out, he'll talk about those different factors and why he believes Kohl's has low uncertainty. Moat is another one. So another thing that obviously influences companies, particularly in the space that Kohl's plays, is competition. And every company is impacted by competition. And economic moat, of course, is a sustainable competitive advantage. So those are factors about that company that can keep competitors at bay. So that would be, well, we have a number of factors that go into uncertainty. Competition is something that faces every company. And so it's sort of the degree to which we think that company can hold off the competition. So interestingly enough, Kohl's, no moat. Woolies just got awarded a wide moat by Johannes.
Interesting.
Which
really
is interesting.
Huh.
Well,
personally, I really like the economic moat rating, and you can also filter this on the Morningstar site, which is great. So you can just have a look for wide moat stocks or narrow moat or no moat. But like the proof's in the pudding there. We were always a Woolies family because it was close, and I don't know, we just were. And then I moved, and then we became a Kohl's family because Kohl's was closer. So there's no moat there. There's no protection. There's no, it's just it's interchangeable with their competitors.
Yeah, absolutely. And I think this is an interesting case with Woolies having a moat and Kohl's not. But like Doug was talking about CBA earlier, and CBA, all of the big four banks do have a wide moat based on the same moat factors. So one, just their ability to access funds for cheaper than any of the smaller banks. So that's one thing. And then switching costs. So if you have a huge, from a market share perspective, you have a lot of market share, people tend not to switch their banks.
Yeah.
So it's very easy for Doug's example where he moves. It's very easy for me to switch as a customer between Kohl's and Woolies. It's a pain for me to switch banks because obviously the more products you have, the more people you have in there, your friends and different bills that you can pay automatically out of your bank, you have to go set that stuff up again, and it's a big pain. So when you have a industry with switching costs, and you have certain competitors in that industry that have a lot of market share, it's hard to lose. You have to work hard to lose that market
Well, and
share.
really, you're almost talking, maybe I'm off the mark a bit, but like if you're talking about Kohl's or Woolies or even Qantas or the banks, you're almost talking about like a nationalized investment play on Australia itself. Is Australia going to be okay over the long term? Let's hope so, probably. So these kind of mega brands, mega consumer brands, if not actual stores of capital like banks, I mean, it's a pretty safe bet, really.
Yeah, absolutely. The other thing that I would add is obviously we'll go into valuation. So obviously you can see Johannes thinks that Kohl's is very overvalued. So you can see fair value, 15.50, closing price. Well, it's up a little bit today as well. So it's a 21.49 now. So valuation is also important to think about. If you look at sort of what's happened, particularly at the US market, I mean, the Australian market is actually up since the tariff announcements, which is fairly amazing.
Yeah.
But particularly at the US market, you've seen, and Doug was talking about the Magnificent Seven, you've seen what's really gotten slammed. Well, it's been them. They were also trading at very high valuations. There may be individual reasons why each member of the Magnificent Seven has not done well, but obviously high valuation levels, that's a concern. And the example that I always use is the .com bust. That you sit there and you can look at what the Nasdaq did, what the S&P 500 did, but most stocks actually were up. If you look at that decade, that's quote unquote lost decade, starting with 2000, going through the end of 2009, most stocks were actually up. Like a equal weighted index in the S&P 500 was up, and up a fair amount. I think 6 or 7% a year. But what happened? Well, the largest companies got slammed. There were all these tech companies, and then the other largest companies became banks, and they all got slammed in the GFC. So valuation is important. So something to think about.
Indeed. Yeah.
We had a couple more questions, but yeah, I just wanted to give a little bit of a context and overview. So, Doug, we have someone who sold CBA.
All right.
Yeah, I sold CBA at 144 as the PE was 27 plus, and put money into a term deposit, expecting CBA to fall. CBA is now 166. What is happening? So I don't know what's happening. Doug is a CBA shareholder.
That's
a happy one, but
yeah, sure. Well, it depends on your entry price too, of course. Yeah. It's amazing. A lot of customers come to Sharesight, and when we help them set up portfolios, I mean, some of these people have held CBA since like the pre-CGT era, and you just can't argue with returns, really. But I don't know what's happening. Again, Mark and I were joking, but there's an article from I think Thursday or Friday last week in the Fin, which is like CBA was up 5% today. What the heck is going on? And there's some speculation that it is a flight of capital, say, from the US into Australia. And so like the analysis is, well, Australia safe, well run, Aussie banks, very well run, very safe. Let's just put our money there. There's some of that, but otherwise, it's not. I don't know.
Yeah, like we obviously think it's overvalued.
Yeah.
James Gruber on our team, did this analysis, and CBA is like by far the most expensive bank in the world.
Yeah.
And it's hard to know. So obviously, our fair value is 98, which is way below the price. But yeah, as Doug said, there's so much speculation. Is it super funds and they don't know where else to put their money?
Yeah.
And yeah, it is.
I mean, if you think about like institutional funds from say the US or Japan or Europe coming to Australia, you basically get a 40% pickup on the FX rate right there. So it might be a safe place for them to store assets for the time being. And also, I mean, the frank dividends too. I mean, it's absolutely part of the story with CBA. That's basically, you don't get that anywhere else in the world. That sort of franked dividend.
So a question from Julia: since you're talking about moat, would you generally prefer low moat or high moat? There are cases to be argued for either. Okay, so our moat ratings, we have wide moat. So wide moat indicates that our analysts believe that that competitive advantage is sustainable for 20 years. We have narrow moat. Narrow moat's 10 years, and we have no moat. Listen, personally, companies that have moats tend to be bigger, more established companies. I will say that. So, even things that we cover that are in the small cap space, it takes a while to establish a moat. So, I think if it's a case where that is a very specific strategy that you're going for, you are going for small cap shares where, once again, in general, that sort of range of outcomes is larger. Potentially, that's a situation where you could ignore moat if you saw a pathway to a moat, perhaps. But, it depends upon, I guess, ultimately what your investment strategy is. For me, I would always try to find a company with a moat, but I'm old and boring. So that's sort of and I have a boring investment strategy. I don't know.
No, I don't know. Again, Mark works at Morningstar. I worked there for a long time. I really like the moat analysis, so I think we are probably biased there. I don't know. I always thought it was interesting in talking with Morningstar analysts back in the day, and I worked there some years ago. So tech was not what it is today in terms of the dominant sort of Mag 7 or what have you. But when Facebook IPO'd, I can't recall if it was assigned a moat or not, but it may not have been assigned a moat, like a no moat or a narrow moat company when it IPO'd. But then weirdly, Facebook or Google, they create moats because they create a network effect so rapidly that it just becomes it's a moat generating company. And then there's just other very different reasons for moats as well. I always think about a company like Air New Zealand. It's got a wide moat, I think. Again, please look that up. But it's got a wide moat because New Zealand's small. It's only ever going to have one airline. So there's a regulatory moat, or there could be a patent moat, for things like biotech as well. So, but I personally prefer moat as well. I also think, frankly, it's kind of a nice shortcut in terms of the analyst brain. It's like, does a company have a wide moat? Wow, that must be a really good company for all sorts of reasons. Let's read on and discover why, perhaps.
Yeah, and I would say, and there is a question saying, why would CBA have a wide moat when they compete with ANZ, Westpac, and NAB? One of the things, like if we talk about like a banking moat, for example, right? So why do they have wide moats? I talked about this a second ago, but yeah, they have these large deposit bases, right? That gives them cheap funds. So they have access to capital. They generally don't have to go out and access that from capital markets. So they've got this big deposit base, and they have market share. So, and they're both related, right? So one could argue that any bank that grew to their size would have, it's nothing special about CBA. Any bank that grew to that size would have those same advantages. Same thing Doug was talking about with like Facebook, right? So if Facebook had 1 million people on it, well, it doesn't have a moat. But that network effect builds, just like cost advantages can build as companies scale. They often do, just like something like switching costs. Well, you don't have a moat with switching costs if you have 5% market share, because nobody wants 5% market share. So really that question around CBA, ANZ, Westpac, NAB, they all have wide moats because they all have commanding market share, and we don't think it's likely to change. So that they are able to fend off small competitors. In general, like capitalism is obviously competition. And so, if somebody is doing well, somebody's going to compete with them. Nobody's going to sit there and watch this new startup dominate some industry and not try to compete with them. Moat is, can you hold them off? I'm going back to my other window. This is all very organized. Buying shares in a company I purchase from. Does Morningstar analysis include a company's dividend forecast? It does. So I will show you that. So we, there we go. So you can see right here. So this is that last that last tab there. So this is obviously for CBA. So what you can see is these are obviously the actuals. So those are numbers that have been reported, and then you can see the forecasts. So if you go down here, you can see dividends per share. So you can see the forecasts that they have. And you can see their franking forecast as well. And you can see their forecast is everything else. So what our analysts are doing is they are building a model where they are projecting out what they believe will happen with the companies they cover into the future. And what we're doing is we're just taking this from that model. So that's where you can see those projections. I will say, and this is it's a Morningstar tech limitation more than anything else. Only Australian companies can you get that. In the US and other places around the world, the analysts are obviously going through the same process, but different databases, so we don't have access to that information.
That's right. The dividends are better in Australia anyway, so.
But yeah, exactly. Exactly. All right. Let's see. Nothing wrong with being boring. Thank you. I've been a member of Morningstar and Sharesight since 2019 and love both. Uh-oh, Doug, now you have feedback. And I didn't read it before, so now you're going to get it live. Over the last 12 months, there's been a change in the portfolio, and it's a lot harder now to confirm dividends.
So we made a change. I think what the person
Talking about the consolidated
yeah.
view.
So on the holding page itself now in Sharesight, we've gone to a tab structure. That's probably what this individual is referring to. So there's a trades and income tab. If you go to that, you can still bulk confirm those dividends. It's just a tab away as opposed to being on the front page, the first page.
Okay, so that's a consolidated view.
It's a change in our UX. Really, frankly, to make the product go faster. So it's in the trades and income tab, but you can still bulk confirm them in there.
Cool. All right, it is 1 o'clock and we're out of questions, which is good for us. But my email address, mark.lamonica1@morningstar.com. Do you have any questions? Email me. Yep. Sharesight help support.
Yep. Support@sharesight.com, or just hit us up on the widget in the bottom right.